certainly something about anniversaries that, that always get people excited.
Well, it's interesting. There's a lot of stuff that happens around anniversaries, especially around the 4th of July. And I don't know whether it's necessarily or whether it's directed or whatever. But, we fought in the Civil War. Today is the 150th anniversary of the second day of the Battle of Gettysburg, which, if you've never been there, is this idyllic little farm town in south central Pennsylvania. And on June 1st, or July 1st, 2nd, and 3rd, 167,000 people gathered to fight a battle, the largest battle ever fought in the Western Hemisphere. 46,000 of those 176,000 end up as casualties. 8,000 of them died outright. So you had a 28% casualty rate, which is enormous in a military outfit. The other thing is, you think about it, we've been complaining about the weather around here being 80 and 90 degrees.
Oh, no matter what the weather is, we complain about it.
It was 93 degrees all 4 days that the troops were present in Gettysburg, and the humidity was about 85%, and these guys were wearing wool uniforms and probably hadn't bathed in a long time. So, you could probably detect the enemy by the smell.
And no bottled water.
No bottled water, yeah, exactly. And, and there were some great heroic parts about this, including the attack by the Confederates on the second day on Little Round Top, which was thrown back by the 20th Maine, which is the subject of the movie Gettysburg, starring Tom Berenger. The war, this battle turned the Civil War. And, on July 4th, Vicksburg fell in the Mississippi, which opened the Mississippi to navigation, which divided the Confederacy. And, at this point, the Confederates had lost the war. If the Confederacy had won at Gettysburg, it's very likely the U.S. would have been a divided country.
Interesting.
It was that close.
And so almost to the day, of course, years later, but, the Declaration of Independence and then potentially keeping the country together.
87 years later, as Lincoln would say, 7 years ago. And, it's interesting. He went to Gettysburg in November of 1863 to deliver the Gettysburg Address. He was not the featured speaker. A guy named Edward Everett from Massachusetts was a leading orator of the country at that time. He spoke for 2.5 hours. And it was ironic that one of Lincoln's lines in his 2.5-minute speech was, the world will little note, will long remember what we say here. And nobody can remember anything Edward Everett said, but most, when I was going to school, we had to memorize the Gettysburg Address. So,
do you still know it?
I know most of it. I wouldn't want to put myself on the spot
Dennis,
here, Ben.
for some reason, if there was somebody who remembered it, I would believe that it was you.
Yeah. The other thing that happened close by is actually the second most studied battle in American history, and that's the Battle of Little Bighorn happened on the 25th of June, 1876 in Montana. It's still a holiday for the Northern Cheyenne tribe, by the way. Killing Custer's a holiday out there.
That's funny.
So that was 137 years ago. So, pretty amazing.
And, again, these are anniversaries that there's no fireworks going off, I suppose, unless you're in Cheyenne country.
Or in Gettysburg. Yeah.
They have fireworks?
They have little fireworks.
Okay.
145, 150 cannons going off simultaneously.
Oh, wow.
That'll
and then, of course, as you said, you're when you have these anniversaries, oftentimes it's not necessarily remembering them. It's after you forget them that...
Well, yeah. I mean, in the stock market, we say, nobody ever rings the bell at the top to tell you the top of the market or at the bottom, The only time you get your bell rung at his anniversary is when you forget your marriage anniversary and your wife rings your bell.
This is true. So as we go through kind of this summer season and the 4th of July, I think it's certainly an iconic holiday here in America. You know the joke, right? Does Canada have the 4th of July?
Yeah, they do have the 4th of July, except they celebrate it on the 1st of July, which is Canada Day.
Oh, well, that wasn't the joke I was thinking of, but touche. Yeah, that's good. You knew how to bust on my own joke.
They just pronounce it wrong.
Yeah. So what are some of the things that you see kind of in the financial markets going into this season? Because in some ways it's cyclical. I don't know if it's cyclical per the seasons or the 4th of July in particular, but... in some ways there is some cyclical pieces of the puzzle of investing that must come around every year.
Well, typically summers get slow. And this goes back to the old days when New York would get so enormously hot before air conditioning. And everybody would send their wives and their kids up to the shore in Maine or Massachusetts or someplace. And the men would work until Thursday afternoon, and they would leave and get on a train and go visit them. So things slowed down because people were on vacation, and they still slow down. You get a lot of junior traders in there. So what we end up with is a lot more volatility during the summer. Now, there's been this traditional thing that you'd sell stocks in May and go away and this kind of stuff. It didn't work this year. Market hit its high in May and has been in a correction ever since. The correction is not outside the bounds of what normally happens in a correction after a big run like this. So that's not the real issue. The real issue right now that everybody's facing is two, basically. One is what's happening in the emerging markets with money flowing out of emerging markets, and what's happening with interest rates in the United States. And that's probably going to be the story for the rest of the summer is what happens in those two areas.
Why? Well,
the emerging markets, China is slowing down. Okay, let's put this in perspective. China was growing, GDP was growing at 12% annually. It's now going to slow down to a mere 7%. There are countries in this world that would slice their wrists and sell their firstborn children to get a 3% growth. And here China's worrying about they're slowing down to 7%, and that may not be fast enough.
Well, they got to get people in those huge ghost
towns.
Exactly,
all those cities that they built that nobody's living in. So they've got a real problem there, and as they've slowed down, they have slowed down their purchases of raw materials. Raw materials come largely from the emerging world. So economies in the emerging world are slowing down. They're not seeing the same inflows of capital. The other thing that's happening is in the United States, real interest rates are rising. Now, let me explain this. When you buy a bond or anything that pays interest, there are two interest rates you have to be concerned about. Nominal rate, which is the rate that they say they're going to pay you, 5%, 2%, or whatever it is. And then there's the real rate, which is the nominal rate less the rate of inflation. That's the real cost of money. And typically people borrow a lot of money in high inflation times because the real cost of money, if you're borrowing money at 7% and inflation is at 11%, they're paying you 4% to borrow the money. At a time like this, however, inflation is very low. So if you're borrowing money at 2% and inflation is 1%, you're paying 1% real cost for money. And historically, that's an enormously high rate of return. Well, what's happened recently is the real rate of interest in the United States has risen, which has sucked money out of every place else to come back and get the highest real rate of return. These emerging nations need capital, they need constant flows of capital to develop. And when that money starts coming back, the U.S. currency starts to strengthen. Our bond markets get weaker, so people come and buy, and money sucks out of the world. And because we're the reserve currency, we then have to pump more money out to keep the world from collapsing. That's our job in the world. And that's what's going on right now. And at the same time, the Fed's talking about stopping buying bonds. And so, nobody knows. They've been buying 50% of all the mortgage securities issued.
Yeah.
So the question is, let's suppose they cut that back in half. What does that do to mortgage rates? Nobody has a clue.
Well, even the discussion around it raised rates
right.
almost a full percent, which is unheard of. I mean, they went from 3.5% to 4.5%, which is 1% on the outside. But really, that's like a 33% rise in interest rates.
Right, and think about what that cuts down your buying power if you're trying to qualify for a loan.
15 to 20% in 30 days.
Off the price of the house. So,
yeah.
And how much have house prices risen in Seattle in the last 6 months?
Oh, it's almost 1% a month.
How about 15%?
Yeah.
15% off the buying power, 15% increase. I don't know. Is that a coincidence?
Yes, I would say so, because the mortgage market is national, not necessarily tied to the Seattle real estate market.
But it is interesting to see that the buying power, the rise in rates is roughly equal to the rise in prices of houses.
Yeah.
So, I'm not saying it's going to collapse or not. And, from my personal opinion, the Fed can't stop buying bonds. The economy's not strong enough. So this is all, basically, games people are playing. But nonetheless, people are playing them.
Well, we've talked about this a lot also, though, is with interest rates so low, a lot of banks are just borrowing money and then pumping up the stock market.
Well, that's right. And that's been going on. And the banks are sitting on the money. And one of the reasons inflation is so low is because money is not moving around the economy. We see real estate money moving. We think we see money. But the velocity of money is about 1. In other words, they put $1 in, and it just floats around the economy. To really have inflation, which is what the Fed's trying to engender, you have to have a velocity of about 2 to 3, which means every dollar has to turn over 2 or 3 times a year, and it's not happening. And if that doesn't pick up, we're not worrying about inflation. We should be worried about deflation, which is why real rates are going up. Real rates are going up because inflation is falling, not because interest rates are really rising. It's because inflation is falling.
Dennis Gibb joins us, president of Sweetwater Investments. So, Dennis, if the risk you feel like sometimes is deflation versus inflation, maybe first explain that, and then let's get into just a little bit of what that means.
Okay. Most of us throughout our lives have dealt with inflation, which is where prices rise one year over the other. And prices still rise. They come up with these indices, but sometimes you'll see these things. Well, it only went up 1% when you take out gasoline and food. Okay, so if you don't drive a car and you starve to death, you're great, right?
That to me is the funniest number.
It's stupid,
and it's everything, because everything gets driven somewhere.
Exactly. I mean, it's just absurd. So when that number starts to fall, when it goes down year after year, at first that's called disinflation, which means inflation's coming out of the company. But eventually it reached what's called deflation, which is where in real terms prices fall year over year. When prices fall, people stop buying things because their dollars will buy more if they wait. In Japan in the 1990s, the hardest thing to get in Tokyo was a safety deposit box, because the Japanese were taking their pay in yen, they were putting it in a safety deposit box and just leaving it there. And about a year, they take it out, and it would buy 5 or 6% more, because that's how far prices had come down. Deflation is really, really hard to break once it gets in. It's easy to break inflation. Deflation is really hard to break, and that's what happened in the 30s. We had a deflationary decline in the Great Depression, and no matter what they did, it was really hard to break it. It finally bottomed itself out and went back up, but of course they didn't have the tools we have now. So what we're looking at right now, with no velocity of money and with a lot of assets still on bank balance sheets, and especially in Europe, that are bad and still declining in value, we're still looking at deleveraging, which is eating up the money that's being pumped into the economy, which means the economy is slowing down further and further. And as you take leverage out of the system, the economy will slow down until it reaches a bottom. The real issue here is deflation, not inflation.
See, and I agree with that, because I've also looked into just some ideas about this, right? If you have a whole bunch of people, like, a lot of people say that the lowering of the unemployment rate is like the McDonald's and Walmart economy, right? A lot of people are getting hired at these very low-paying jobs. Right. And, if you do research on Walmart, you'll see, Walmart's like slavery. First, they pay you low wages. They tell you to go have the government subsidize them, and then they have you shop at Walmart. So literally, all the money just stays within the Walmart circle, which is a whole other conversation. But my point is, there are too many people in this country that really couldn't even handle inflation on a lot of items, because there's so many people who are having a hard time making it month to month as it is.
Actually, inflation would be better for those people.
You think so?
Yeah, because it brings wages up faster. Wages rise with the rate of inflation typically. When you have deflation, people don't raise rates. They realize they can get things cheaper, because not only can you buy things cheaper, but employers can get employees cheaper because there's no upward pressure on rates. And as long as we have a labor market that is not tight, where people are not, we have more people looking for jobs than we have jobs available, employers can do what they want. And the biggest deflationary impact in labor isn't Walmart, and it isn't Costco and the rest of the stuff. It's technology.
Yeah.
You can buy a computer that can replace a lot of people. And that computer over time is going to cost less than health care and Social Security benefits and all the rest of this stuff. So companies are,
computers, robots, whatever it is.
Companies are stewards of capital. Their job is to take that capital and use it the best way they can to produce a return. And if the best way to do that is to bring robots in, that's what they're going to do. They're going to do it every time. And it's always been that way.
Yeah, look at the way cars are made, or any manufacturing.
Cotton gin, or any of these things going all the way back to the beginning of the country. Whenever they needed to come up with a way to do it, they deflated the economy by coming up with a technological aspect. That's one of the great aspects of America. We always find a technological solution to every one of our problems sooner or later.
Yeah. So when you start looking at what's going on right now, I guess in America, it's one thing. What about other parts of the world, and how that really affects our country and what we're going to be looking at?
I think the two things that are on the international scene you got to be really careful about and watching right now are China. What happens in China, whether their liquidity situation that they're in right now gets better and they can start actually making loans and the economy can start going. And you got to watch out for the situation in Egypt. This is probably the single most dangerous thing in the world right now is Egypt exploding. This is the largest country over there. They are extremely well armed, thanks to us. They have a great deal of influence in the Middle East. They can close the Suez Canal. They can do a lot of different things over there. And if Egypt blows up in a pro-democracy type of move, it could spread across the rest of the Middle East. And the Middle East is never quiet. But when Egypt starts getting ugly, the Middle East gets ugly, and that's the thing I'd be watching through the summer is what happens with Egypt.
And then how would you say that would affect what goes on in the investment world?
Well, I think what happens is when people get nervous, their first thing they do is protect themselves. And so if volatility over these sorts of things pick up, people will start selling stocks. People will start, trying to find protective areas. They'll go to cash, or they'll do whatever they're running. And again, the Middle East, the markets will adjust to what they think is the perceived risk. And if the risk goes up, markets will adjust to a lower risk situation. Volatility can be good for markets. It can be bad for markets. But what really kills markets is uncertainty, and uncertainty is the ultimate risk. If you're uncertain, you never know what the risk is. Mm-hmm. And that's the risk you're trying to hedge away all the time. So, and I mean, think about this. We still get a lot of oil from the Middle East, and there's a lot of different things going on there that people who are allied with Egypt or whatever, and that thing blows up. You could see some oil disruptions. You could see, countries sending troops back and forth. You could see a lot of ugly stuff happening over there.
Yeah, it seems to be something we're always keeping our eye on.
You got to.